Welcome back, traders, to the channel. So today we have a lot of information to go over, so I'm just gonna talk through this really quickly instead of typing it up nice and clean and having a robot read it to it. So bear with me today as we get through all this information. So the first thing I want to look at, obviously, is just the overall market, looking at the SPY. What we mainly focus on here. I guess I will mention off the bat, we will also cover the trade updates for the Amazon and the AMD trade at the end of this video. So I'll chapter that out below if you want to jump to that portion just to see how those trades are doing, or see what adjustments we made to them and see how they're doing. But first we'll start with the market. Following that, we'll go into some macroeconomic news, and then we'll do the trade tracker. So looking at the SPY here, we can see that just as we expected in the last video, or maybe I shouldn't say expected, but one of the scenarios we kind of planned for was a sell-off down to that 412 level. You can go back and check last week's market update, and that's essentially the area that we assumed if we did sell off to, we would find resistance due to some of the Fibonacci ratios and previous ranges of trading. You can see we're just starting to enter that last trading range we were trapped in for a while. You can see there's lots of activity that happens around this area, kind of shown in this red box here. You can even extend it out a little bit further back in time and see. So, you know, rather this range holds for some range trading, we will see. Though I do like to look at big, nice round numbers as psychological targets, and I would be shocked if we didn't have some back and forth fighting around the 400 level. I'm sure that, you know, there's just lots of people that are more or less passively involved in the market, and they just turn on the news, and if they see, oh, the SPY's over, you know, 4,000, or it's, you know, below 4,000 on the SPX or this futures, you know, that's all they're going to hear about and talk about at work. And I can tell you anecdotally, outside of trading, there are many people asking me on Friday, like, what the hell is going on with the market? So it's starting to get kind of ugly out there for some of the people that are just, you know, loosely paying attention for their 401ks, which is ultimately what we want to see if we go back into a bear market. We're going to need sentiment to get really ugly for people just to start panic selling for some kind of rollover. But getting away from the psychological nature of a lot of trading, let's look at some of the bigger pictures of this SPY. Traded down here, what we have here, the Fibonacci ratios of the, you know, all-time high to last year's low, and we also have a pair of Fibonacci ratios between the recent highs and the all-time lows. So we can see we cracked through some of the levels right here, and then this other Fibonacci down here. So the next area of support, just based on the Fibonacci ratios, are also coming in right around 400, and probably a more serious one right around the 404 level. One thing I like to keep in mind, just kind of as a reality check so we don't get too carried away with being bearish, is looking at the RSI. We can see the RSI is getting near the area that we tend to look for bounces, just as far as an oversold indication goes. I generally like to look around what looks like around like a 22 reading on the RSI. Just historically, if you look at some of these bounces, it's been around that level. So, you know, I am personally prepared for a small bounce. I still have a net negative delta in the portfolio, though it's substantially reduced to about less than 100 or so negative delta. And if we bounce up, my plan is to basically have all the volatility plays come in, and I'll profit on that, and then I'll redeploy some cash with new shorts if the VIX gets lower. I don't like buying new puts when the VIX is up here at 20 or above. I like to try to slowly add to the put positions while the VIX is cheap, like it was back in July when we were peaking out. So that's kind of the overall picture for the SPY right now. We'll pop into the other way we like to look at it using TradingView. First, we'll look at a weekly chart to kind of get an idea. We can see that, you know, from our DK trading indicator, we're trading down into, you know, what we read as more of a neutral reading. So it's not really pointing you in any direction to get long or short the market on a weekly time frame. It's just simply indicating, hey, this previous run up, these green buy signals, and these, you know, it'll go into blue when it's less buy signals. That trend is more than likely over. We can see, for example, here we had a run up, and then we went into this neutral, and then, you know, we tried to fight back into bullish and back into neutral, and then eventually what came to be the, if you choose to call it a bear market of 2022, the bear market. So, right now, potentially, maybe we're at a level here where we're preparing for another sell-off that could be extended, or maybe it's just a pause that stops before another bullish trend. We don't know, but this is what we're looking at on weekly chart. On the weekly chart, it's probably easier to see some of these daily moving averages. These moving averages that are plotted here, the exponential ones, and then the yellow and the red are going to be the simple moving averages. Specifically, the 200-day is the red and the 50-day is the yellow. I plot those because there's lots of traders and lots of program traders that look at these specifically. And right now, we're clearly getting a very bearish signal. We are trading below them. They are still positively stacked, meaning the 50 is above the 200-day. So for many people, that is still a buy signal. But specifically, the price action is below both of them, and I think that is a little more important than if they are stacked or not. Looking at a daily chart, we can see those same moving averages translate over to the daily chart. They keep their same relative level. That's you won't find that in TradingView directly. This is programmed in for our own indicators because I don't like when they change on different time frames. I want to keep the bigger picture idea of looking at those. Anyways, we will see the candle colors change though, based on our buy and sell signals for different time frames. So as the weekly was showing, the last 2 weeks are just yellow. If we pop down to the daily time frame, we can see this is 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. They're all, they're going from a buy to an outright sell. So, on the more granular daily time frame, from our DK trend following, indicator, we are in a sell signal. We are below the moving averages, as we were able to see on the weekly chart. And then the EMAs, this teal, purple, and hot pink, they are, we are trading below them, and they're all bearishly stacked, meaning that the shorter term ones are below the intermediate and the longer term EMAs. And these EMAs are the 5, 21, and 50 EMAs, which is another common EMAs that many people look at. So if everyone else is looking at them, I want to make sure I'm looking at them too. So that's what we track here. So that is about it for the trend follower here. I will show we have a new indicator we offer that is it's essentially we have a basket of different buy and sell signals. They get aggregated together, which print the bar colors, and those will change per time frame by default. So right now, of around 15 of our 30 proprietary trend buy and sell signals, we can see we are nearing what looks like 13 and a half of our sell signals. And what we want to see is we have more increasing sell signals if we're betting bearishly, as we are. And as the bars turn, more of this bright red color, it means we are increasing the number of sell signals prior to the previous session of trading, which is a daily time frame right now. If we were to have bullish signals, if they're increasing, they're align, and if they're decreasing, they turn to this dark green. So that's kind of how you could read this. The orange is a moving average of I believe a 10-period moving average of these buy and sell signals aggregated, and then the yellow line is actually going to be the current count of buy or sell signal. So one other thing I do want to mention about the RSI, as we are being prepared for bounces, because the RSI is getting so low, we don't want to totally just assume we're going to have a bounce, because we can see, sometimes the trend follows RSI, and sometimes RSI is an indicator for a turnaround, right? So to give you an example, if we saw this low reading here, if we were to position for a bounce, you could see the market's price action didn't reflect that, even though the RSI started to diverge and go up. Ultimately, over this time frame, we had a further lower low price action. There was a bounce here, but it was actually still at a lower point relative to where we would have started to position bullishly. So, I like to use the RSI as more of just a warning. Especially on a shorter term, you can get oversold and have a bounce. But if this market's going down, you're going to be able to see lower prices even with raising RSIs, just because the rate of change of which is decreasing or increasing to the downside. So are some things I want to mention about rates. So if you look over here at these yield curves right here, we can see we have the 3-month 10-year, the 6-month 10-year, the 2-year 10-year, and the 2-year 30-year. We actually were able to uninvert one of these, which is one of the more extreme ones, the 2-year, 30-year, this week. We can see this is plotting the 2-year, 30-year yield curve. We turn this off. Actually, let's leave that on. We can see we first became inverted over this 0 line is inversion, which is this blue solid line here. It was first inverted along with all the rest of them back about 18 months ago. You can see here's the 3-month 10-year. The most popular one everyone looks at is the 210. It first became inverted, for this recent session around July of 22. Looking at July of 22 on the 2-year, 30-year, you can see we became inverted then. We did retest this. We became uninverted here and here, but I would say this current session of cutting back through the 0 bounds is probably going to hold, and we're probably going to uninvert all these yield curves, and this is the first one signaling it. Now, the thing to remember that is important is the yield curve typically is what, is a signal of a recession. Many people will say there's a lot of debate against that these days. I still firmly believe the yield curves being inverted is a sign that there will be a recession soon. But trying to time the market, generally speaking, it's the uninversion, which is closer to when the equity sell-off actually begins. So if we are bearish, this is a good sign. We actually want to see these uninvert. Maybe next will be the 210. You can see we're getting close. We still have quite a ways to go. One thing that I find is very interesting with the 2-year, 10-year, pair is during the global financial crisis or the 2008 crisis, the peak of inversion was 0.22%. If we were to go to a monthly chart on this, we can look back. I have a giant arrow here kind of pointing out the 2007-2008 period, and you see this was the peak. So we are substantially more inverted, or have been substantially more inverted than we were at any point in time during the 2006-2008 crash, which is quite alarming to me. So here we have, we are just now, even though we are coming, this yield curve is, steepening more so. We are still so much more inverted than the global financial crisis. So I think that's just alarming and should kind of scare the shit out of everybody. Looking at the yields specifically, we can see we have the 1 month here, 2 month, 3 month, 6 month, 1 year, 2 year, 10-year, 30-year. And the thing that I find quite interesting to look at is every single one of these are over 5%. Personally, if you can buy bonds directly, or you could buy an ETF like BIL, I do not know what the appeal of being in stocks is right now. Currently, if you sell everything today, we are still up more or less 10% for the year. We'll look at that in a minute. It's just like, if things are getting ugly out there, you can buy bonds and get half of, the returns you expect in a year and have no principal risk. It's just duration risk. But if it's money you're using for investment, this is what I tell all my dollar cost averaging buddies, you can right now get half the work done for your money and take no risk. And if you're wrong, you collect your interest. You get your money back when whatever duration maturities you buy, mature. So treasuries mature. You know what I mean. So it's, I don't know. I think I'm always advocating for people to be more active with their trading. If you want a dollar cost average, great. But I think there is some benefit in doing it yourself sometimes. You can, by being a little bit more discretionary. That being said, so all these are over 5%, except for the 10-year, which of course is what everybody looks at. It's what you'll see going across the ticker on CNBC and everyone talking about on the news. So, go figure. The one bond maturity that is most popular is probably being, held down by the government more or less on the way that they buy and sell treasuries and what they choose to issue. This week we had a 7-year issuance, which was actually a pretty good bond yield. There's a 2.7 bid to cover ratio, and people are still wanting to buy our bonds. Generally speaking, it's a little bit higher than that, but these days with the amount of money we're issuing, it's kind of amazing that there's still a bid to buy our bonds while Japan is necessarily not buying our debt quite as much because they're having to defend their own currency. Our Federal Reserve is not buying, our bonds because they are still participating in quantitative tightening, which we can show here. Here's a chart of the Federal Reserve's balance sheet. You can see this week we are now, last week we were under 8 trillion as well. We've continued to decrease the holdings of the Federal Reserve as a balance sheet, which is, it's composed of them stepping in to buy U.S. debt that's issued. The government needs to raise money to fund the government. They issue debt. And then the people that buy the debt, they give the government money. The government spends it. So when we're blowing all this money, which we added another $600 billion onto the federal, debt this last month alone, it has to be sponged up. That means they have to issue more paper, and people have to buy this paper. And if no one's going to buy the paper, if the biggest buyer in the world, Japan's not buying as much, if the Federal Reserve, the second biggest buyer, isn't buying as much, who's going to eventually buy all this debt? And when no one buys it, the price of bonds go down, making the yield go up. And which is what we're currently seeing. This is the yield on the 10-year. So this means people are paying less and less for the 10-year because they want to be better compensated for it. They want lower prices to get higher yield if they're going to step in and buy it, because if inflation comes back, which it seems like our government's not all that serious about actually fighting inflation, because they're not wanting to raise rates any higher. If they think inflation is going to come back, then who cares about collecting 5%? Because that 5% is going to be eroded by inflation. So who needs it? So anyways, so looking at the Treasury, this is the Treasury General account. So this is essentially the government's checking account. We can see that it is continuing up. They're continuing to raise more money. They're raising money by, once again, issuing debt. So they're going to keep selling more bonds to keep raising more money to fund the government. And, we'll see how high this goes. As this goes up, you would expect bond yields to go up. And, with all the geopolitical conflict, you would expect people to be buying more of the bonds, because ultimately it is, a safe asset, the asset people pile into when there's fear. But right now, even with all this Israel conflict going on, there is not that big of a bid to bonds. Another way to look at this, probably how a lot of us are trading this, is through TLT. If people are buying more bonds, TLT would be going up. And we keep seeing this continued sell-off. We are screaming sell as far as our indicators go. We have a negative 15 rating. I'm currently very long TLT through selling puts, and I'm going to continue to get longer and extend those out for years if I have to, because eventually the game plan is the government will be forced to cut rates, because when we have this recession, they will need to stimulate the economy. The only tool they have to do this is to cut rates. And when they do that, you're going to see a principal appreciation in TLT to the tune of maybe 30-40%. Just because this is math and this is how that TLT trades, it is pegged ultimately to bond prices. You can imagine back when interest rates were basically 0% during the corona, that puts the value of TLT greater than $150 per share. At interest rates of 5, we're down to 80. So let's say the government freaks out and they cut by 100 or 200 basis points, which I don't think they will. If we actually have a all-out recession, they're going to do the same thing they did in 2008, because there's no way that they have learned from their situation. And they are just going to cut to 0 again, and you're going to have a giant spike in the prices. So, if they cut back to 0, where is TLT going? I mean, it's clearly going over 100. So that's the bet I'm making. It's a very safe bet. It's taking a lot of capital. It's not the most capital efficient trade, but I think it's a fat pitch, and it'll eventually play out, and I have plenty of time to wait for this to work. Eventually I'll just be put stock if necessary, and I'll just hold that until I'm ready to sell. And if you are put stock in TLT or any of these bond ETFs, you're collecting dividends. So, it's fine. You're essentially, looks like every TLT offers a dividend every month, and, it's not a bad yield. It's going to reflect just shy of whatever the 30-year is reflecting. So right now you're probably getting around 5% annualized, which is great. All right, there's a few charts I want to look at real quick. One of the charts I find particularly interesting right now is how Wall Street is positioned. So there is the prime book right now still has lots of the mega tech stocks, we can see it's the Microsoft, Apple's, Google's, Meta, Amazon, Nvidia, Tesla combined. There are still lots of holdings on, I believe this is Goldman Sachs Prime Book. So, there is fuel to push this market lower if they begin selling this. So that's all I wanted to point out. Here's a discussion talking about the RSI previously. We can see this blue line is the S&P 500's RSI. As we were looking at, it's around 30 for our bounce zone. The thing that is a little bit different here, when we've had other readings of these low levels, this white line, which is the sentiment indicator that AAII puts out, and it is typically at a lower point. We're still quite elevated relative to these other previous lows. So that means there is a whole bunch of, large money managers that recently have more or less bought stocks. Probably not a great time if we're going to continue this sell-off. So there is, more fuel to the downside if selling continues. Another way to look at positioning is, by this Goldman Sachs positioning indicator, you can see we're reading 0. This is not overly bearish or overly bullish. So this market could go either way right now, and maybe not so violently. I'm imagining when we get readings like this, you typically get moves in the market where if it's going to go down, it's just going to be a gradual grind down every day until we get to these over extreme regions where we typically have a sharp reversal to the other side. It's just kind of like a rubber band being stretched. So if we continue to drift down towards 400, that would make a lot of sense to me. It seems more and more these days fundamentals absolutely do not matter at all. It's I'm a firm believer of a lot of the stuff that Mike Green has been saying about positioning and ETF flows is really all that drives the market these days. It's sad. I like the idea of, maybe I romanticize the idea of stock picking and looking at balance sheets and trying to determine, a good company from the pack and betting on it to get some, a better return than the indexes. But, the world we're in today seems like to me individual earnings and fundamentals don't really matter all that much. However, you would expect, like, even though the short term feels like they might, on a longer term, if a company has awful earnings, you would expect it does have some kind of effect on that equity. What we can see here is the percent of companies that are reporting this quarter so far that are guiding higher or lower earnings per share, and we can see there's typically a trend here. Not only is this trend kind of just looking at it from really far away, it looks like it's decreasing, it is also below the median average. So if companies are guiding down, generally stock prices have to follow, because the companies are going to be more conservative with the way they spend money. They're probably not going to expand much in R&D. They may not overproduce because they don't want to worry about inventory builds. They may lay more people off. They lay people off. That's worse for the economy. That brings the market down all on itself. So it's stock prices ultimately should follow earnings, and it's at least the estimates and the guides are trending down. Another way to look at this is the number of or the companies that are beating estimated earnings per share and sales. We can see that they are rolling over recently, so that's not good. Another chart that I like to look at to really keep things in perspective, because I ultimately see if this market's going to crash, we need to see the big mega 7 companies all fall. And this chart tells me there is still lots of fuel for the fire. It could fall. Way we want to look at this chart is this blue line are the kind of the top 7, or I guess the AI 9 stocks. It looks like they're down here. It's a lot of the same companies we've been looking at they've really been propping up the market this whole year. So just looking at this last year, we can see we are still quite elevated just for this small basket of companies. If you look at the S&P itself, it's the green line. You can just kind of ballpark it here. The market's up about 10% here. It was up closer to 20 earlier in July. But if you look at the market minus these top companies, we're negative on the year. I mean, it's just the overall fundamental of the market is not doing great. I mean, the fundamentals meaning the foundation, the bulk of the 500. And I know there's always, this isn't equal weighted, and you always will have a small group that outperforms. Though, there is something to be said for if you can identify the companies that are making the bulk of the gains if they're starting to decrease and the rest of the market isn't catching up, then there could be a capitulation event where these get sold off very hard, and that's just going to make the overall averages absolutely get crushed. So anyways, those are some of the bigger macroeconomic charts I wanted to point out. Looking at a few more sentiment indicators and other ways to kind of gauge if this market is oversold or not. We are reaching this extreme fear gauge. Now, while this is kind of a silly gauge, a lot of people look at it, which makes it more important than I would like it to be. So I am weary of bounces when we start getting into this extreme fear region. So this, is 1 point for the bulls here. This might signal a reversal. Another thing I do want to point out, which I think is actually strengthens the bear case here, is we see quite elevated VIX futures. We get a lot of talk about this Santa Claus rally at the end of the year and everything, but what you can see is past the end of the year into January, the VIX is much higher, and as you should see a higher VIX in the future because there's more uncertainty going out in time. It's not telling the opposite, where VIX is lower. So things are presumed to get worse as far as the VIX is telling us right now, and premiums that people are willing to pay for options are out there. So, that this is maybe 1 point for the bears. This is another chart that many people look at and constantly talk about all year long, which is very annoying to me because it's a stupid chart. It is just showing the seasonality of basically every year going back many decades of the S&P, and they like to point out that during November and December it is typically the most bullish span of the market. And whether that's true or not, this is just a chart that we have to acknowledge is a very real thing, and it basically reflects the market tends to go up over time, and we all know that. So this chart kind of tells us nothing. It really, I think, glosses over every sell-off we've ever had and makes you think that sell-offs are impossible, and we know that is simply not true. The last chart I want to talk about for positioning and flow data is just looking at what spot gamma produces as basically their dealer net gamma exposure. We can see that the 0 level is where this line crosses the 0 bounds, and if we go down to the x-axis, we can see that shows up right under, it seems, 4,200 on the S&P right now. So with us trading down here at this last close, we are clearly still in quite negative gamma. Now, this doesn't mean the market's going down. It simply means that there is a higher chance of volatility, and that volatility could mean the market is violently moving to the upside or the downside. But in general, with higher volatility, you're going to have more of these vol funds that are volatility-based funds are going to be told to sell right now. And they just don't allocate quite as much into equities, and that alone, a lack of buyers, can force the market down, even if there's not a surplus of sellers. So something to think about, consider whenever we are in negative gamma territory. I tend to like to lean short, and we are certainly there right now. Okay, in this next segment, we're going to get into the trades that we've been tracking together and talk about some of the recent adjustments. So this last week was the 21-day mark for these positions, and since we are following the tasty trade mechanics for at least these trades, we want to go ahead and roll them to the next expiration cycle. So on this chart, we have Amazon. The previous strikes we had were the 145 and the 115 from the last update when we did a little bit of a delta adjustment. We went ahead and rolled to the next month and into the December 15th cycle. And now our short strikes are 150 and 135. So we can go ahead and change this here. And our new strikes are 150 on the call and 115 on the puts. So we didn't move the puts, we just extended that month to month. And the calls, we were able to actually raise the strike price a little bit to have a larger range for Amazon to trade within. So I've plotted out here all of the individual trades and adjustments we've done for this trade so far, just because tracking this through the previous videos can be a little complicated. So just as a review, I'll go over real quick. We started out with the order entry on the 11th, and these are the strikes we sold. These are how many contracts. We're just doing a one lot for this example. They were in the November series. Here, each one of these lines, these are the puts, these are the calls, this is the price we sold them at, this is the net credit or debit we paid. It's looking at credit, so it's positive, that's money coming into our account. So you can see here, we sold -1, so we sold a contract for $2.33, so obviously that's positive for us because that money's going in our pocket. And then you can see the ones that we bought are debit, so they're subtracting, but total for this one order was initially $253. We then did a delta adjustment on the 20th. We rolled the calls down because the stock moved down. And then we did another delta adjustment where instead of rolling both the long and the short calls down, we actually widened out the strike and just rolled the short strike down further. Collected another credit. Or I believe this was call 45. Yeah, anyways. And then just recently, yesterday, on Friday, we rolled from November to December on both of our spreads. So we had to do this in two separate orders. And we said we were able to roll the puts, and then we were able to then sequentially roll the calls. We were able to roll all the puts for 52 cents. We were able to roll all the calls for 78 cents. If you add up all these orders together, currently we've collected $5.39. And there is $2,000 of collateral tied up in this trade because we have we only have a $1,500 tied up in this trade, which is very nice. That means we've collected over a third of our maximum loss. And you can quickly calculate that by seeing that there is a 15-point wide spread between our strikes. So we have, 150 minus 135 is 15, so it's $1,500 of collateral. And then our new strikes in December, we have a 20-point spread. So yeah, that's what I thought. This trade does have $2,000 in collateral tied up. So we've collected about a quarter of the maximum risk, which is fine. That's what we'd expect. So this trade will look at the theta and delta of it. So currently in Amazon, this trade we have on is slightly short. It has a delta of -9 right now. Of course, that's going to be dynamic as the stock swings around all day. That's going to change. But right now we're collecting about $7 a day in theta. So that is ideal. So there's been a number of other trades that has led to the pricing of this particular trade we have right now. So the profit and loss is going to be a little off up here, but we can see that we have our long put, our short put, our short call, and our long call on this price chart right here. And so as long as the stock price stays within this region that's green, we'll ultimately be at a profit. And you can see we're skewed right now where the width of the put spread is a little bit longer, so we do have more risk to the downside. I personally like to keep it that way because if the bottom drops out of this market, we can always sell our put, sell our long put, get long stock at whatever our short strike is, and then just hold the stock. Ultimately, I wouldn't mind owning 100 shares of Amazon. If we're trading 85, I'm not going to want to hold them at 115. But if I get put stock, you can turn it into investment really easy. If we blow through the call side, you just lose money. So I always like to, if I have to skew these, I would rather skew them where my max loss is less to the upside. And if we sell off, we have room where we can widen the spread to an equal width, collect more credit. So it gives us a little bit more dynamic delta. If we need to get more, if we need to adjust our deltas, we can also make this spread tighter if we need to for a small debit. Hop over to the AMD trade. So for AMD, you can see we've continued to sell off along with the rest of the market this past week. So because of that, we've had to do some delta adjustments. In this case, we ultimately, just like Amazon, we lowered our calls a number of times for this adjustment. We can look at the order entry here back on the 13th. This was the Iron Condor we initially started with, collecting $360 or $3.06 in options terms per lot. We did an adjustment by rolling the calls down, collecting another 65 cents. Did another delta adjustment, similarly just widening out the strikes for another 60 cents. And then on Friday we did both our rolls. We rolled the puts. This cost us money because since we sold off, we were sold nearly down to our strike price. The deltas on our short put was getting in the 40s, which means you're getting very close to your strike. So we had to pay a debit to roll. So we paid $1.65. So that hurt our profitability of this trade a bit. Though we were able to collect a credit of $1.20 for rolling the calls. So overall, this is still a net debit. We lost about 40 cents on the roll, though we're positioned in a better spot now where hopefully our probability of being profitable, at least at this point in time, is better. So right now, we are short the 110 call in December, and we are short the 85 put. That is what we currently have plotted up. So this is the range we are in right now. Looking at the AMD, you can see here are our strikes right here. AMD as a full trade is slightly long. That makes sense because we're closer to our short call than our long put. We are balanced here, I believe, with looks like we're $20 on the call side, and we're $15 wide on the put side. Looking at the trade analysis, we can confirm that we are wider on the puts than the calls, just like the Amazon trade. If we stay in this range, we're all good, but if we need to delta adjust, we'll either widen these out, roll to the next month, or close the trade if it is getting really ugly, or get put stock. So we have optionality here. All right, well, that's all I have for today, except for I have one more thought to think about. Maybe comment in the comment section below what you think about NVIDIA. You know, NVIDIA is looking very enticing. I love seeing this gap here, and I just think it would be amazing going into Christmas if it totally surprised the market. This absolute darling of the market this year, if it was to seal this gap up. I don't think anyone's positioned for that. There really doesn't seem to be much short interest in NVIDIA, and everyone just thinks that it's impervious now after this huge gap up it's had and held for over a quarter. But if you were wanting to short NVIDIA, premium's quite high, but you could throw some butterflies maybe each week leading into Christmas that are out below this gap. If you were to seal this gap, there you could have a pretty nice trade. So it's just something I'm thinking about this weekend. Nothing new on yet for NVIDIA, but it would be quite substantial if this was to get reversed and just have an absolute washout, similar to how Tesla did last year. I think this caught a lot of people off guard going into the end of the year last year, where we just sold off absolutely, disgustingly down to around $100 per share around Christmas. I don't think anyone was prepared for that, and it really so either way, thank you again very much for tuning in and listening to me ramble about the markets. I hope this is informative, useful, and helps you with your trading. Let me know if it does, and I'll talk to you next week. Thanks.